So we're giving people a minute to file in, and I see we've got a bunch of people already here. So why don't we start, and welcome to VentureCrush on behalf of Lowenstein Sandler. We've been putting on these events for 22 years, 23 years. So it's been a while, and we're going to drop some things in the chat. I'll give you a little bit of housekeeping first, during which I will bring up my colleague, or we will bring up my Lowenstein colleague, Juan Soto, in just a minute for a brief minute. We have panelist bios, and there's a link to an Airtable, so you can read a little bit about Joanna and Jasmine. And if you have questions for today, you can drop them in the chat, and we'll try to get to them during today's discussion. I'd also love to reserve a little bit of time for particularly emerging, but not exclusively emerging managers to ask some questions. I also want to thank our Lowenstein Sandler colleagues, Ike Omaruna and Shelma Ulis, for doing the research on Joanna and Jasmine in advance of today's event, which was cool to read. And tell us who you are. If you could drop some info on yourselves in the chat, that would be great. Include your LinkedIn, people can connect. We know that Zoom is not as good as hanging out at a conference and getting coffee and complaining about the panelists, but there's still an opportunity to connect, and we know that people are doing that. As always, we use closed captioning. You should too. We want to make sure that our events are inclusive and people feel welcome. And this is the part where we want to spotlight Juan. So we have a new event coming up. It's our VentureCrush Americas. It's on October 11th. And we're going to have Isabel Rafferty Zavala from Canela Media and Carolina Huaranca Mendoza, who is my partner and co-founder at First Close Partners, and my Lowenstein Sandler friend and colleague, Juan Soto. It's an in-person event, but also a Zoom event, so hybrid. VentureCrush Americas will gather founders, senior execs, angels, VCs, and other investors focused on supporting and growing the startup and growth company ecosystem in Latin America and the Hispanic Latinx communities in the US. It'll be an annual New York City-based gathering, bringing together the VentureCrush Americas and broader VentureCrush networks for great discussion and for networking. There is a link in the chat that you can sign up on. That's October 11th. And Juan Soto, anything else you want to share with us and tell us a little bit about it?
Well, thank you for that, Ed. I think you covered the high-level basics. We're super excited to expand VentureCrush into sort of LATAM and Latino and Hispanic communities here in the States. Like Ed mentioned, and for the veterans of VentureCrush, we're bringing back the in-person component. So the panel will be broadcast over Zoom, both for those in New York, or who will be in New York during that week, which is LAFCA, which some of you might know. There will be in-person networking as well. So thank you, Ed, and very excited to have the inaugural VentureCrush Americas.
Great, and Juan, you head up our LATAM practice, and you've been doing venture in Latin America. And is the event going to be largely in Spanish, a little in Spanish? Can someone, or put another way, despite my middle school Spanish language skills, will I be able to, participate and understand most of what's going on?
Well, I know you're a great French speaker, so you're almost there. But the event is actually going to be in English. It will be Spanish open. Everybody there, I'm sure most people will speak Spanish, but it will be in English. So if you're not a Spanish speaker, don't worry, you'll definitely be included as well.
Okay, awesome. Thank you very much, Juan. And maybe you'll give us a question a little later about, for Jasmine and Joanna, about the LATAM or Latin markets. Appreciate it. All right, so that's October 11th. Our next VentureCrush Africa Global event is on October 26th, and that's led by our partner Rossi Turman, as well as Deandra Chin and Raquel Smith. That's at 11 a.m. Eastern by Zoom. We're going to discuss gender disparities in venture funding in Africa, and there's a link to register for that. And final event that I will mention, our partners Meredith Bouchaw and Alyssa Fredericks. Meredith is a New York-based partner, and Alyssa is based in our Palo Alto office, are hosting an event on negotiating financing term sheets for women in venture. It's no secret that women are underrepresented in VC and sometimes struggle to have their voices heard in negotiations and otherwise. So please join our partners, Alyssa and Meredith, to take a deep dive into key terms in venture term sheets in a changing market. That's in person in New York and also by Zoom, October 18th at noon Eastern. And there's a link for that as well. Final link and housekeeping, VentureCrush FG pod program now open. You can apply. It does not cost anything to apply, nor does it cost anything if admitted, and we will do a pod in person in New York, as well as continuing our remote pods to enable greater geographic spread. We had an Africa pod, and we did folks in other parts of the world as we have in the past, and we're excited to be reviewing those applications and launching that for, I think, the 13th year. So, all right, with that, on to Jasmine and Joanna, who are going to tell us everything there is to know about how allocators are navigating the choppy waters in the current market. And so first, we're going to do a little bit of bio and background on Jasmine and Joanna, who have a couple of interesting overlapping points, not the least of which is that they both went to Chicago. Jasmine, why don't we start with you? Tell us a little bit about life before University of Chicago for you. Where are you from, and what was the path that led you through MIT to University of Chicago?
Absolutely. Yeah, no, it's definitely started way before then. Grew up in Queens, New York. Went to public school for most of my life. Mother was a public school teacher as well. So grew up in Queens. And then for high school, did the standard New York thing of applying to all the fancy schools in New York, but also was admitted to a fantastic program called Prep for Prep, which is based in New York, that gave me an opportunity to also look at independent schools here in New England. And so ended up attending Middlesex School, which is a boarding school in Concord, Massachusetts, for high school, which is completely different. And ended up staying in Boston for school. And I remember at the end of my time at MIT, my offer was to take a job with Hewlett Packard that was in Boise, Idaho. As a woman from Queens, I don't know how exciting that sounded, and so did what half of my class did and came back to New York and entered finance, where I think at the time there were even banking teams that solely wanted engineers on their team, so it was a good time to switch, but entered finance through private client services, which for me, because all my internships and everything was in engineering, was a good foray into the space, because it gave me an opportunity to see a little bit of everything, right? Because we were managing total portfolios for clients. So I made a deal with a team at Bear Stearns that I would program a database for them if they taught me everything else. And so that's kind of how I made that switch from engineering into finance, and was able to come home, which I think, and obviously I have my own bias, but I think if you haven't lived in New York, everybody should spend some time living in New York at some point, and in your 20s is not a bad time to do it. And so had a great time, but ended up in a role as the associate for an equity research team at Oppenheimer, and loved what I was doing, but realized that my career, especially within equity research, is very leverage towards one person, right? Like, and started realizing that if this person, left the firm, or, God forbid, got hit by the proverbial bus, right? Like, I don't know where that left me. And so that's what got me thinking about business school. And given the way that Chicago's program is structured, absolutely loved it there. And because it allowed me to be advanced in some areas and start from basics in others, there was a lot that I learned on the job, a lot of things that I wanted to go back and start over, as well as with business school only being 2 years, a school that gives you quarters rather than semester, I felt like I could also get a higher, hit rate on content. And doing undergrad at MIT, I never got the opportunity to do study abroad, which was something that I really did want to explore. And so second year, winter semester is not a bad time to leave Chicago and not be there. I think the particular year that I was gone was the year there was that big thunderstorm and everyone got trapped on the highway. So I was spending time in South Africa, which at the time was their summer. And it was a fantastic opportunity just because their capital markets are different than ours, right? Like in terms of development. And so spent my time there really looking at private equity and a lot of the earlier development of those markets in an emerging markets, which was a fantastic time. There actually is a teacher from HBS that is from Africa. And so around that time, he comes back and teaches at the school. And so was able to take tons of great finance classes. And that's what, inspired me to flip to the buy side. And so once I was at State Street, we started looking at outside managers, and I got the opportunity to work at a really small fund of funds in Philadelphia, where all we did was emerging manager portfolios for about 20 or so of the state pensions. And that was really my foray into what I do now. And it leveraged my background of having been at the different parts of the investment bank. I can understand what managers do, how the capital markets work, and use those in our assessment of those managers, but now doing it in a place that I feel personally more tied to and meaningful, being able to work with fund managers in their early life development, see them grow, be able to be early supporters of those. I find that particularly meaningful. And so now in my role at Cambridge, I was able to create the team here. And so my team now works across all asset classes and really focuses on women and people of color rather than a specific asset class, which due to tons of historical inequities in capital markets, they tend to be newer and smaller. We certainly don't restrict it only to emerging managers. But that is a large part of what we do. And so being able to introduce those managers to our clients, which span from high net worth individuals to corporate and public pensions, I think is a tremendous opportunity. And so really just loving what I do now.
So, so much there. And I want to go back to Bear Stearns. You made a deal with them where they teach you everything that you needed to know about financial analysis, et cetera, and you would do software programming of a database for them. That database wasn't like mortgage-backed securities, was it? Because Bear Stearns like almost crashed the entire financial market.
It was auction rate security, so it was close.
Seriously?
It's not my fault.
I'm sorry, but you programmed a database of auction rate securities in what year?
What year?
At Bear Stearns?
It was
pretty
around,
much your fault.
I left before 2006 though. I did leave before.
Okay.
Yeah.
All right.
Before, yeah. So.
All right. So after your slow burn efforts to take down the entire world financial market, I just want to go back and by the way, I love that Peter Boyce. First of all, Peter Boyce is awesome. Second of all, I love that he's here and shouting out an endorsement for Prep for Prep. It's great to know about those programs and to find out which of your friends, which of the VCs and founders and other people you admire have been touched by those programs. I know SEO and MLT are also programs that have had a huge impact. And I'm glad that you didn't go to Boise, although I had nothing against Boise, but I like the endorsement for New York. You said that your team works across all asset classes, but focuses on women and people of color rather than on an asset class, and that not all of those managers are emerging. And
Correct.
one of the things that I have sort of fought against is the perception that when you talk about underrepresented managers, you are only talking about emerging. And it would be awesome to dispel that misperception. It would be great to start with a definition of what an emerging manager is, and then we'll cut into Joanna and come back to you for some other stuff. But Jasmine, what's a definition of emerging manager? And then Joanna, I want to hear yours.
At my former firm, it was, managers that were, if you were talking about public markets, right, like below 2 billion in firm AUM, if you're talking about privates, right, like funds 1, 2, 3, I think all of those, you have different definitions in different states. I think in some ways defining an emerging manager is harder to do, right, like than an underrepresented manager, because it really does switch from institution to institution. And it's a large part of what we do when we initially engage with a client who want to focus on this area, is really tease out what success looks like for them. Because even within emerging, are you talking about, sometimes we've had pushback on the backgrounds of individuals, right? So are you talking about people who have come from disadvantaged backgrounds, or are you talking about, strictly a race and gender? Are you talking about specific geographic concerns that you want to target? Are you talking about, on the private side, who a strategy is investing in, or who are the GPs in making the investment decisions? There's a lot of different visions of success, and I think all of that gets rolled up into this emerging manager definition, and it's really important to tease out specifically what the goals are.
Great. Joanna, anything you want to add to that? And then we're going to backtrack to your bio.
No, I was going to say, I think it's everyone has their own definition, which is good and bad.
Okay, well, it is good and bad, but please do not assume, if you take one thing away from my piece of today's comments, please don't assume that an underrepresented manager is emerging. Please don't assume that an underrepresented manager is looking for, and this drives me bonkers, mentorship. And please do not assume that that because you are dealing with an underrepresented manager as a potential allocator of assets, please do assume that it is a financial opportunity to make a shit ton of money. So we'll leave that. Go ahead, Joanna.
Yeah, I was going to say, and I would agree, Ed, and I would also say, the challenge with emerging is it can indicate where you are in your journey. But if you look at somebody who spins out of a large firm and they have a very durable track record, I mean, technically we consider them emerging. They're a fund 1 or fund 2. Mm-hmm. So I think these broad labels are not always very helpful.
Yeah, exactly. All right, so you're not in Kansas anymore.
I'm not.
But you were at some point. So tell us about Kansas and Chicago and where you started.
And first of all, I have to say thank you for having me. I'm excited for today's discussion. And Jasmine, we have more in common than I realized. My mother was a public school teacher and my father was a coach, but then ended up leaving coaching to become an entrepreneur. So I have some entrepreneurial blood in me, if you will. Grew up in Salina, Kansas, which is a long way from New York and a long way from Chicago, but went to the University of Kansas, which was a great place to start my educational career. And I am actually a trustee for the KU endowment and serve on the investment committee. So it's really great to see some of these public institutions with sizable endowments able to make a difference in the lives of ordinary people. graduated from KU and moved to Kansas City, where I worked for a place called U.S. Central Credit Union, which was like the Federal Reserve for credit unions, which were not for profit. So I've always had a passion for aligning my professional career with something that I hoped made a difference. And I continue to be a believer in credit unions. At the credit union, I ended up at the end of my career, I was co-managing the desk, and we were doing investing in fixed income investment grade securities. And I was also leading our derivatives and structured investment efforts. One of the early lessons I learned at a place like the credit union in Kansas City is we were not the center of the universe, and certainly not the center of the financial universe, but we had a lot of assets under management. And I found very quickly the value of partnering with smart people in the center of change. So, and that has been a lesson that I've continued to learn throughout my, or continued to draw on throughout my career. So went to the University of Chicago for many of the same reasons that Jasmine mentioned. And unlike Jasmine, who was a New Yorker who could have gone to Boise, I was a Kansan who went to New York. And I agree, you know, spending a couple of years in New York was eye-opening and career-changing. I went to Goldman in the municipal finance group for a few years, and I love New York, but it wasn't home. So Goldman moved me back to Chicago. And then I ended up wanted to get more on the principal side of things, worked at a place called Security Capital, which was, they had a real estate investment banking arm. So did that for a bit and did feel this pull to align my career with a broader purpose. And at the same time, having worked doing direct investments, I knew I did not want to go back to direct portfolio management, and had the opportunity to join the university. There were a number of things that were appealing. First of all, a global investment universe and multi-asset class, and being able to partner with GPs. I started as the manager of public equities and then was asked to take on the COO role. So ran the business of the endowment for about 5 years. And then about 11 years ago was asked to move over and take on the private equity portfolio. So that's me in a nutshell. A couple other things I will mention. I did do the Kaufman Fellows program when I moved into private equity. I needed a way to really accelerate my learning and my network building and venture, and that was incredibly valuable. And then, since part of this is about diversity, equity, there is a group of institutional allocators. Many of you will have heard of the institutional allocators for diversity, equity, and inclusion. I have to give a shout out to Rob Hari at Rochester. He was one of the folks who helped get that off the ground, and I am delighted to be a part of the steering committee for that organization.
And we have had a number of folks on VentureCrush who have been leading the charge in one way or another at IADEI, which I think is doing a great job and is one of the silver linings of the cloud that enshrouded us in the summer of 2020. And Rob is definitely someone who had a lot of conversations, but then actually like followed through and kept it going, and Sophia Sai as well. It's been great to see. So you mentioned real estate and municipal
to be LPs that are going to have to make a decision about whether you re-up with an existing manager, not necessarily having all of the information you would like to discern that skill from luck. I think that's what's going to be a little bit hard right now.
I would add, I think that there have been some managers who are very skillful and very disciplined, who have over the last 18 months, and even now to a certain extent, look as though they've underperformed, right? Their portfolios are strong, but they might not have had a lot of follow-on financing. So they're marked at a 2.2 or something. And then you get other folks for whom, you know, they invested at a very rapid pace and their companies had a lot of rapid markups. And we're seeing some of those funds that might have been marked at a 4.5, all of a sudden it's marked at a 3.5. So my 2.2 guy, who looked really weak compared to my 4.5 guy, now is going to be marked at 2.6, and my 4.5 guy is going to be marked at 3.5. Yep. So you're beginning to see the fundamentals, frankly.
So, all right, I want to back up a little bit and explain what it means to be marked at 2.2 or marked at 4.5. And we're gonna assume that there are some folks here who are not involved in marking to market or reviewing things that are marked to market in venture. So would one of you like to explain it? As a quick side note, we didn't realize when we were being nice to Rob Rabari that he was actually here and listening and would respond in the chat. It's cool that he's here and responded in the chat with his email address. So go look for that. But just so that people know, I was surprised to see that. That's great.
I think his camera's even on.
Shocking. Fantastic. All right, Rochester in the house. Okay, so mark to market.
Go Jasmine, go Joanna. Thank you, everyone.
Mark
Jasmine,
to market.
do you want to take mark?
Yeah, so so mark to market is a tool that managers have to use when they're reporting the performance of their company, that you purchase a company at XYZ value, right? Like, and maybe even if you haven't invested in a subsequent round, maybe there is now a new valuation for that company. And so you get to include that in the performance, and that'll come through to your GPs or LPs in their reporting. I think the wrinkle in this is that there are different valuation policies also that different managers use. And to Joanna's point, that's something that we've also been looking at, because there were managers that we were diligencing who were in that camp of looking like a 2.2, but there were even companies within those portfolios that I know another manager that we looked at had those same companies magically marked at a different point because they have a different valuation policy. And Cambridge's, obviously we use the benchmarks, which are a result of where the marks that everyone is using in the industry. But we recently have had to take into account how much of that is inflated versus real. And so what we don't want to do is unnecessarily penalize the person that is a 2.2 simply because maybe they haven't had those markups that other people are taking. Maybe they're being more conservative in their valuation. And so, yes, I think in general, LPs are probably digging far beyond whatever marks GPs are advertising at this point.
Okay, so it raises an interesting point, which is, if we're looking at the shadows on the wall of Plato's cave, and they may be meaningless, they may be meaningful, and there are some comments in the chat that are, astute observations, like interim marks are virtually meaningless from Randy, which echoes what Jasmine had said to an extent. And Victoria is asking, how do you differentiate managers who were disciplined versus those who may not have been, when the final outcomes may be the reverse at the end of the fund? And certainly if you were an investor in Fab years ago, you had a great markup. If you were an investor in Fast, you had a great markup. And there are other companies that start with the letter F, I'm sure. Theranos, you had a great markup. So let's talk about diligence. Diligence has changed. Other than looking at markups, what are you seeing people do to take advantage of the additional time they now have to do diligence?
And Ed, is that diligence on GPs?
Managers, you
On
doing
GP.
diligence on managers.
I'm pleased that we're back to in-person to a certain extent. And I don't think, barring another pandemic, we'll make investments with managers purely virtually again. There is a lot of value in sitting down in a room with someone and seeing the team dynamics. And I think if, one of your questions was around what will we have learned coming out of this, what was missed? I think team dynamics is going to be one part of it. I think it's virtually impossible to really understand what's going on with the team remotely. So in terms of taking more advantage of time, I think it's spending a lot more time in person. I think the other thing that's going to happen is if you say what was a manager's edge or competitive advantage in a bull cycle that was really pretty unprecedented, it was speed and money, right? If you could be fast and you put a lot of capital behind it, those were your competitive advantages in a bull cycle. I think we are now not in a bull cycle. So what do those competitive advantages look like? And I think we're now going to be diligencing those types of competitive advantages, which hopefully is what many of the LPs were doing all along, particularly folks who were more experienced in the asset class, but not everyone.
Jasmine, do you want to respond and in particular also highlight whether you feel the same way about Zoom diligence versus in person?
Yeah, I think what we're probably doing more than we were doing before, I would reiterate, is digging down into the fundamentals of the underlying companies. And to Joanna's point, I think what's different and what matters more in this coming market, and we've done some research around there, it's going to be growing your operating your portfolio companies. It's not as much about sourcing, and I see that a lot where what managers are advertising and selling, is everyone has, a proprietary deal flow, which I think is hard to substantiate specifically, in early stages. Everyone, will talk about their ability to source different deals. And to some extent, I think that's going to matter far less than how you grow your companies. And so it's doing more calls with references to understand specifically what is the added value, doing a lot of spending time with the underlying team of who is bringing what skill sets, to your portfolio companies. Why would a founder, choose you? What are they getting out of it? Things like that. So I think we're going to focus a lot more on the operating aspects of strategies and managers than we probably did in the past. And I think on the Zoom, I go back and forth. I agree that I do in meetings, you are looking for that team dynamic, who's speaking more than others, how are the team members relating to each other. But one thing I think I have enjoyed in this Zoom environment is being able to meet with relatively junior staff in one-on-ones without someone standing over their shoulder. Being able to have just direct time with individual team members, where I feel like I've been able to get more candid information, which I think is honestly what we want. I think we seldomly want, sort of the glossy marketing pitch. You want to be able to be a long-term partner with the fund manager, and that means, knowing, the good and the bad.
What about the debiasing effect of pitching by Zoom as opposed to in person? Can you talk a little bit about what the debiasing effect is and whether that's something that we're going to lose the benefit of?
And I will say, if you asked me in April or May 2020, was I concerned, right? Like that we would do that flight to quality, which means we just go to the existing names, the existing people that we know. And I've been pleasantly surprised that I think it actually has been an opportunity to do the opposite. Now that we do use Zooms, I think there's a lower barrier for getting to sit in with a manager, to getting to know a new idea. I think we've seen a lot more uptake and easier socializing of investment ideas through Zoom. We've been able to meet with more managers rather than less because there's not travel involved. I also have enjoyed not asking managers who maybe are working on a tighter budget, right? Like to fly into Boston, for 2-3 days, so that, we can say this was, part of our process. So I think in some ways it has increased opportunity, but the volume also we've been in an environment where the volume is also super high. So it's been hard to keep up.
And Rohini asked a question which combines a couple of questions, and because she also mentioned fund names, I'm going to quote her question with the caveat that I do not expect Jasmine or Joanna to comment on any specific fund or company, and I believe that it would probably be problematic for them to do so. I'm certainly happy to comment on specific funds or companies to the extent that I can. And I'm sure that I will do so in pure self-interest. Okay, so the last event, this is Rohini Chakravarty's question. The last venture cycle brought up many emerging managers that are quote unquote top tier, and I'm going to add brackets, a term I have a problem with, which we'll talk about later, that are top tier names now: Emergence, Felicis, Amplify, True, A16Z, Ribbit, et al. By the way, et al is not a venture fund, just in case you were wondering, but it probably will be tomorrow. And part of the reason was that established firms were consumed by existing portfolio protection and generational transition issues, meaning that their portfolio companies were in trouble during the last major downturn. And if you didn't have to save your flailing around portfolio, you had an easier time of it. How do you see these dynamics play out in this cycle, noting that a lot of Bay Area VCs have moved to Florida, Texas, or Nevada and have cashed out? It's a great question, Rohini. It combines like 7 or 8 things that we had discussed before the event.
I was just going to say it's a great question, but it does have so many different elements of it. One of the things first of all, I will say, I do believe that this is going to be a great inflection point for a lot of newer managers who don't have legacy portfolios, who've taken a bit more time to invest. I was on the phone with one of our managers the other day who said, I am seeing unprecedented opportunities. And how are my LPs going to react if I speed up my investment pace? Because I've been so disciplined, but I'm like, this is a once in a lifetime opportunity. So I think a manager in that sort of a position is going to do very, very well and come out of this, very strong. The other piece of it was I was at an AGM, and the first 20 minutes of the AGM were spent talking about the emotions of greed and fear through an investor lens, and talking about the fact that many of the people around the room are frozen and they're very, very fearful, and their entrepreneurs are fearful. So that firms that are in that triage mode, if they were savvy, I think you have a couple things going on. You have secular trends supporting innovation and investment in venture capital and technology that will continue through this cyclical downturn. So one of the questions I'm asking myself is, for our GPs, who's had the skill to ride the secular wave and the cyclical wave? And I think that's what we're going to be able to kind of begin to discern. So if you've been really caught up in this hype cycle, I don't know if you're going to come out the other side, but there are probably secular forces within your portfolio. If you've backed some really strong companies, that will continue to generate or will generate strong returns over the longer term. And then in terms of the geographic dispersion, I think this is one of the other long secular trends is we are going to be seeing a continuing democratization of entrepreneurship, which will lead to the democratization of GPs. You don't have to be in Silicon Valley anymore.
I think what I heard in that question was over the last cycle, right? You had newer managers that were able to establish themselves because they saw or were able to capitalize on opportunities where others weren't, right? Like for whatever reason. And I think that that's just part of the investment thesis of why I'm doing what I'm doing, right? Like, I think that my team is completely analogous to Cambridge being early in privates, Cambridge being early in impact investing. I think that women and people of color, and I don't need to regurgitate, the stats to this room, are just in general, a massively underinvested in opportunity. And that's what we get paid to do every day. And so we obviously as an industry aren't where we ideally want to be, but there was a Latino owned firm that closed their debut fund at $1 billion last year. There are managers that have come up, over the last couple of years that now, right, like are on funds 3, 4, right, like that are reaching, what they perceive as scale. And I think they're doing it at a time, Ed, to your point, that I think this is a tremendous investing environment. And so what I'm looking forward to seeing is this new set of quote unquote whether it is or is not the right term, emerging managers. I think there's an opportunity for a lot of those to make a name for themselves in this environment. I'm looking forward to it.
So the opportunity to make a name for yourself and the fact that a lot of existing managers are going to have bandwidth consumed by tending to the portfolio and to a large team, that is going to create more potential movement.
Or just fishing in a homogeneous pond that is getting smaller and smaller demographically, right? Like part of the investment thesis is that I think women and people of color see opportunities and founders in other places that, that people don't. And if we just look at the stats, that's the growing set of entrepreneurs. And so I think they are investing in companies and seeing value where others don't.
So, I mean, this is, as you know, and I know we've talked about this, this has been a thesis of mine for many years. And in 2013, I published something in the Wall Street Journal noting that if 52% of all VCs in America have degrees from the same 10 schools, and 87% of them are men and 89% of them are white, how can we possibly have an expectation that the array of insights will be infinite, right? And with the demographic shift we're expecting to see at some point between 2040 and 2050, there's also, a difference in who's consuming what and who's making the majority of the purchase decisions on a dollars basis, on a headcount basis, et cetera. And so having an understanding of the need for the variety of insights rather than outsourcing asset allocation decisions to where people went to school and the jobs that they marched into because those were jobs that were discussed around the kitchen table is a very different it's a very different thing. And in terms of diversity as an economic engine thesis, it feels like in 2020, we had the onset of what I'll call a George Floyd, Breonna Taylor moment where people announced initiatives that they would spend money here, they would look at funding these kinds of funds, these kinds of founders, and a number of people followed through, a number of people did not. and now we have seen a real pullback. Is part of the flight to safety a retrenchment away from DEI? And what will that mean for underrepresented managers who are looking to raise Fund 2 or Fund 3 as opposed to Fund 4 or Fund 5?
I'm going to say, I certainly hope not. I certainly hope not. I think the world's going to be a bit bifurcated, and certainly, going to some of the big brand name firms, many of whom continue to be male and white male dominated, but increasingly, and I think all the insights you just described, Ed, are super important and super relevant. Where are the big markets? What are the big products that are going to be built? And who are the people who are going to have the insights to build those companies? We're seeing more and more opportunities being driven bottoms up from entrepreneurs who don't look like everyone else necessarily. And you follow the results and you follow the money. And, what are the structural barriers that these folks have had? Hopefully they're coming down, not quickly enough, but we are beginning to see more diversity in our underlying entrepreneurs. And we're also certainly seeing a bit more diversity in our GPs. So I think that you need the proof points from results for this group of people who have raised money over the last 5 years. And where you get strong results, you're going to continue to see the LPs lean in. And I think when you talk to entrepreneurs, like our portfolio began to look more diverse when I took it over, because we were calling our entrepreneurs and saying, okay, how did you decide to take this particular firm's capital? And, I can remember one distinct conversation with a woman founder who said, I wanted a woman on my cap table and I wanted a woman in my boardroom. And there weren't that many funds that could provide that to me. And that's how I chose this particular investor. We're seeing more of that. So I hope that LPs continue to listen. And I will, half of what we do is venture and half of what we do is buyout. And, the disparities are startling across the entire capital markets, but they're particularly, startling in buyout. I mean, we see venture being more forward thinking because of the entrepreneurs and the ecosystems.
Joanna, are you, with your endowment, are you asking in diligence, are you asking the GPs, tell me why your team isn't more diverse? We've been an LP in your fund for years and your team is not diverse enough. Why is that? Or is that not a question that gets asked at this point, and are other LPs doing it?
I think most LPs are asking the question. And I would say that in our venture portfolio, when we're looking at teams, Ed, I had mentioned in the prep, one of the things that would be helpful background is, I've been at the university 21 years. I took over the private equity portfolio about 11 years ago. And when I did, we were fortunate to have a set of relationships with some incredibly well-established blue chip managers. But I was in a position where I needed to build out some additional relationships. So I had a choice on whether to hang around the hoop with the blue chip managers and try to get allocation, or try to back some newer managers. And we looked at where the puck was skating, to use that analogy, and said, certainly you can have firms being built outside of Silicon Valley. And we looked at the seed stage focused funds, where they were typically smaller, and there was a lot of portfolio construction information that would indicate that we could get higher multiple outcomes in the smaller funds. But that also intersected with a more diverse population for some good reasons and some not so good reasons. But that led to a natural evolution in our portfolio of a more diverse set of managers. So if I look across our venture portfolio, we have a more diverse set of managers there. So it's a question that we don't have to ask as much because it's kind of evolved naturally. I think with the larger firms, we're seeing that evolution in those partnerships, more women, more people of color. One of the things that's been really encouraging, I talked to a manager the other day who's done a great job adding diversity to their team. And I asked him what their secret was. And this is a little bit goes to some of the points you made earlier. He said, we've really changed the way that we recruit. And what are the gating criteria that we're looking for? And they're seeing that if they take away some of the branding, if you mentioned, the top 10 schools, and being willing to look at folks with a more, a less homogeneous set of backgrounds, they're able to find incredibly talented people who bring unique skills. A little bit to Jasmine's point about, like, you have that coding skill. Well, you bring someone in who's a fast learner, who's curious, who's bright, who networks in a different way. And we've seen some folks mature into very successful and promising investors. So I feel very optimistic about the venture side of the world, particularly.
Yeah, and I'll say, for us, it's literally a standard part of our diligence, right? So I can't speak for all asset owners. I will say that for us, we have it as a specific section of any, diligence report, right? Like that we publish. We have it as a standard part of our DDQ process for all managers, not just diverse managers, right? Like to release that data on multiple levels. So what I will say is, I think I would have appropriate impatience in this environment. I think there's been a lot of ink spilled about, commitments that were made that we're not seeing the results. But my view is this doesn't change overnight. This is right, like it's doing that conversation that we spoke about in the beginning, where you have to tease out. I think a lot of people make commitments and then realize it's not as easy as just making a commitment. You got to do the work, right? And that work takes time. And so with some clients, we've spent a year working with their committee to make sure that everyone, that we have institutional buy-in on what the goals are. Because what I don't want is for institutions to make commitments and then just go back and backtrack a year later. We want real buy-in. We want real understanding of what the goal is. And I think that takes time. But what I will say is, I think what people have been doing is going back to the fundamentals and hard coding a lot of these issues and ways to address those in systemic ways, right? Which to me is more meaningful than just like making a pledge and like writing a check and then not caring a week later. So we're going back, recreating investment policy statements, recreating, goals for governance. I think it matters not only what the investment policy statement is, but we have all these initiatives around boards, but the board is also different than the investment committee, right? Like an investment committee affects, what we're discussing here, right? So can we be more thoughtful there? And what I've been encouraged by, and our stance, and I think there was a question here, right? Like, would you like fire a manager, or are LPs doing it? If you're not diverse, our stance has been that, the first step is being extremely transparent and consistent. And what I've seen is just asking that question does lead to different decisions. It's not on the shoulders now of women and people of color to change this industry. What I've seen is, if we are asking those questions of those blue chip managers, right, the burden is on them for you to explain to me, in a world where the environment of entrepreneurs, the demographics are changing there, for you to explain to me with a homogeneous team of white men how you are going to convince me that you can source deals across the spectrum? I think that is a question for them to answer, not for women of color to make the case, for why they should be invested in. And I've seen it lead to different decisions. And so I think that doesn't change overnight. And I think we've all seen, bad actors amongst GPs. And I think the questions have been, well, why are they still getting funded? But again, you have no idea what that next fundraise is going to look like, or the founders that no longer want to work with those GPs. And I've seen the impacts of those as well. But I think those effects, come over time.
There's a lot there, and I want to dig into some of it. I know that there are also two questions in the chat that I kind of want to respond to and combine. Victoria Cheng asks, curious, would LPs go as far as not investing into a fund if it was not diverse, or would LPs no longer invest in an existing manager if it was not diverse, or is it more of a suggestion for the GPs? My take from what I am seeing is it is more of a suggestion, but I'm not seeing people in large numbers or in significant numbers say we are opting out because you have failed to fix your DEI problem. I would like to see more people taking a harder line stand on that. And I also have not, I'm in a wait and see mode on what happens to bad actors. I suspect that bad actors will continue to be able to raise funds, whether they shift LPs, but we've become fairly bifurcated. Are you seeing people actually say, if your DEI stats don't look better for your next fundraise, we are unlikely to continue to be an LP?
Yes.
I was just going to say, I would like to say that we have multiple objectives in managing the portfolio, but the primary one is generating returns. That is the metric against which I am evaluated, first and foremost. So the question I go back to is, if there is a group of GPs who, and forgive this, are like all white men who are tone deaf to this issue, will they be able to generate great returns going forward? I would argue that they're probably at a competitive disadvantage. Now, if they've generated strong return, the feedback, and this you alluded to this, Ed, like the feedback loop is just so long. Would I walk away from a group of white men who've generated strong historical returns, and I know that if I take the university out of that fund and they continue to be successful, I'm not going to be able to access that return stream going forward? It's highly unlikely. But there is a point at which you look at the attitude and you say, this is going to become a competitive disadvantage. And I'm putting our capital at risk, or choosing a less potentially successful set of outcomes because I've backed this this manager. I think one of the challenges is, for most LPs who have a very mature fund, that portfolio construction exercise is very challenging. And it is difficult to make change within that set of GPs.
Yeah, I think that is the hard decision, because when you're building a portfolio, right, like you're building it with the idea that you're not investing, at least for us, right? Like we're not looking at assessing a fund, right? Like it's a firm and a relationship, right? Like what you're saying is this a manager that we want to be with for the long term? And your intention there is to continually to re-up and hold that position. You're not saying, you're not just simply looking at one fund and then we plan to make a different decision later. And so it is hard to make those decisions to change. I think what has been helpful for us is, I think, specifically, I think Cambridge just as an institution has always understood the value of emerging managers, specifically within privates, right? Like we'll continually look at the last 10 years. If you look across both VC and PE, 2/3 of the top 10 funds for each vintage year, if we go back the last 10 years, have been funds 1, 2, or 3, right? Like 45% of those have been funds 1 or 2. And so I think we've always had some appetite to look at those newer ideas. And in some ways, those are opportunity. But I think that is balanced by what Joanne is saying, is that in general, right? Like you do intend to re-up. What has been a consideration in addition to the idea of how will you remain competitive with a firm that is completely homogenous, is also the realization that the bar right now is very low, right? Like, and I don't think, right, like 2% of check writers in private equity are women or people of color, right? And so I think at this point, if there is a fund manager that we're looking at that is resistant or willingly blind at this point, I think that that is a statement in of itself. And I think that has been more of a concern because no one is expecting for change overnight, but there has to, at a minimum, be some intent at this point, and it's on us to hold managers accountable to that. But the bar is really low. And so what I've seen come up in committees is that if there is a manager performance or not, that is very obstinate at this point. I think it's extremely telling.
So I appreciate it. I really appreciate, Joanna, your honesty about not, about addiction to the return stream, but also the thesis of, how do you prove you're going to get the best deals? Also, how do you prove you're going to get and retain the best talent? And along those lines, there is a question in the chat, and it's from Tara Bishop with a great sad answer from Nika Eze, and the question is, historical challenge, glass ceiling, are you seeing that changing where more junior diverse team members are becoming partners and GPs? I know that happened at K4 Capital, which is an unusual place, but it is very, very atypical to see that happen. And one of the answers is, hey, that's why there are emerging fund managers who were associates or principals at these funds left and started their own funds. And that's the answer is particular with respect to the Black community. And there's a site to a survey. Are we seeing that transition where folks who look like me are handing the keys to the firm to folks who do not?
I think those are two different questions, right? I think, and Joanne, I'm wondering if you're seeing the same thing, but one thing we're pressing on, and I think this is pervasive across the industry, is also title inflation at this point, right? So are there more people being made partners? Yes. Do I think that it means those people are being handed the keys to the kingdom? No. And so, maybe put that on the list of additional things we have to do in diligence now. But it's not only looking at titles, but who's actually has a vote, right? Like, so now you're seeing this bifurcation between managing partners, general partners, and partners, right? And what does that actually mean at the firm? Because yeah, I do want it to be authentic. You do want different decision makers. And so I think I would say, yes, people are getting titles. Do I know that they're getting handed the keys? I don't know that I completely buy that at this point.
I would 100% agree with you, Jasmine. That's very much what we've seen.
Okay. And I do want to just call out Abigail Archibald from the Mellon Foundation said that there's this push-pull, because if we stop investing with managers who aren't making enough progress building a diverse team, we then lose the opportunity to continue to push them to do so. Whereas, we're distinguishing between those managers who are making an effort but not succeeding yet versus those managers who are tone deaf to it. And I mean, first of all, I love the fact that people like Abigail, like Joanna, like Jasmine, who are overseeing billions of dollars. I believe that Chicago's endowment, and I'm not asking just about the PE pool, but the aggregate endowment that was published, and I'm not asking what it is today or anything unpublished on public, as of late 21 was over $11 billion. So when you hear that the Mellon Foundation or University of Chicago with its $11+ billion and top ranking are pushing LPs, or the Cambridge, given where Cambridge sits, is has a number of their clients pushing. Those are important things to to hear, understand, and consider. And yes, 2% is insanely low. So I want to talk a bit about what we're doing in this summer, that people took a breath, people took vacation. Does that mean that we're going to see a really hot deal market in October, in November? Are we now at a level of normal, but we've just gotten so used to the sprinting we've been doing for the last 20 months that normal feels a bit more sluggish?
I was going to say, I don't think we're going to have the pace resume as it was. I think there's just too many different elements that need to be digested. There needs to be a valuation reset. I think there were a lot of folks who, I'm going to use the tourists, right, who are not going to make it through the next 9 to 12 months. So I don't anticipate that the pace is going to resume. I certainly hope not. I think from an LP perspective, most everyone I talk to has recalibrated their commitment budget to a certain extent, which means you're going to take more time to make your decisions and you're going to write smaller checks. And if I think about that flowing through to GPs aren't going to be able to come back as quickly as they have been. We're advising all of our GPs to think about adding 6 months to their fundraising period and communicate well in advance to all LPs what their fundraising schedules are.
So I want to make sure I understand that. When you say add 6 months, you mean delay the onset of it for 6 months, or extend the actual fundraise period so that you're essentially eating dinner from 6 p.m. to 10 p.m. instead of from 6 p.m. to 8 p.m.
It is the latter. I think it is
Okay.
going to take long, the like speedy check writing. Of course, we're going to re-up with you. You were here a year and a half ago. We know you. We're just going to do our pro rata. I think that is going to be increasingly difficult. I think LPs are going to be making some decisions about who they continue to support and having to probably walk away from a few managers and or cut their check sizes. And I've seen that across the LP community, and I've talked to a couple of GPs who had launched their fundraising with an expectation that the LPs would be there with similarly sized checks, and they were told, well, maybe we will be there, but our check size will be half of what it was. So if I think about that flow through, I think you're going to see the same thing with GPs backing entrepreneurs. And we go back to that triage issue, Ed. Like if you're busy taking care of your portfolio, you're not going to have as much time.
Yeah, I think at some point the math just doesn't work, right? Like, so let's say traditionally new commitments, right, like should be funded through distributions from existing managers, right? Like we all know distributions and realizations have been slower and slower. Fund managers have come back not only with larger funds, but instead of one fund, I now also maybe have a continuation vehicle. Maybe I also have an opportunity fund, right? So that existing investment now, like, blossomed into 3 that maybe you also now want to staple. And so now you, right, like are going to to hamstring, right, like your LPs into committing to all three. And you're also now, instead of coming back every 2 to 3 years, come back every, 1 year, 18 months, right? Like at some point there's nothing to pull from. And so it was great to have a little break in the summer. But what we're seeing now, and we're trying to encourage managers to do the same, Joanna, just expect for it to take longer, come back earlier to give people notice, because I saw that this year was going to be tight in January because we're doing our annual budgeting of existing investments. How much space do we have for new investments, things like that, right? Like you're trying to plan out your private equity pacing for the year. And we're already having conversations now about 2023, because a lot of the managers that probably were hoping to raise money end of this year, their compromise is that they're going to push it into early next year, right? So in some extent, we're just kicking the can down the road. But I think people are going to have to make harder decisions. One of the clients that we partner with has instituted a rule where they're committed to only re-upping with 75% of their managers. And they've instituted that rule as a way to first, instill that discipline of looking at new ideas, not looking only at the early, but that they also do have a commitment to invest with diverse managers. And part of that gap between willingness and ability is you've got to make space. And so not that all that money will go, but it forces them to have that opportunity on the table. And so, yes, I think at some point we have to, there's got to be more rational expectations.
And my partner, Carolina Horanco Mendoza, raised this point in the chat about the stapling of funds, which is, we know you want our seed fund or early stage fund. You also have to invest in our core, in our, growth fund or opportunity fund. If you want that, even though we don't really have a record of doing that kind of fund. Are we seeing a tapering of that, where you are only going to see maybe 20% of the folks who spun up a core versus opportunity fund go forward in that configuration in the next cycle? Or are we seeing a situation where people are going to go to market and maybe it's 75% or 80%, even if that second fund is a little smaller?
I think the power dynamic has shifted somewhat, and we have walked from a manager who required a pro rata allocation between a early stage fund and a stapled fund. And I think in other environments, it may be more difficult to do, but I think LPs are going to have a little bit more power. I also believe that in the environment we've been in, everything looked great, right? And I wonder if some of those later stage continuation funds aren't going to bear the brunt of a market correction a bit more severely than some of the seed and early stage funds. So I think we may see some numbers that support saying, like, I'm a great seed investor, but my follow-on strategy, not so much.
And I think the pitch for the opportunity funds has been, right, like you're getting the best of in this portfolio from 1, 2, 3. I just don't know if you did that on these funds, then what does that successful one look like? So is this now, the best of from 4, or so? I think I expect to probably see less of it.
I mean, actually, Jasmine, that's a really good point. And the best of was typically those companies that needed to raise a lot of capital, right? So it was almost definitionally the folks, the companies that had raised the most capital that had the opportunity funds invested in them. And again, I think it's too early to say, but that's what I wonder if we'll start to see. Some of those more capital efficient companies deliver stronger returns.
Okay, so now we're getting into an area where you've got an obverse reference point in the recently announced Figma deal. And Figma is an interesting deal for many reasons. It's got a $20 billion valuation. Obviously, it needs, regulatory approval to close. If that deal closes, a number of funds, some of them very large, are going to return a multiple of the fund on that one deal alone. It is also the opposite of capital efficient. That is not a knock on the management team or the financing strategy of Figma. It's just that, a whole bunch of money went in to that company. Are we going to see more deals like Figma, or is Figma an aberration and nobody told the parties to that transaction that it's 2022, not 2021?
I'm hoping Jasmine will take that.
Yeah,
I mean, I think it's testimony to, the technology and the markets right now. Is this a rational acquisition? I think that the stock price would say probably not, but I don't have any unique insights.
Yeah, I think my general take has been that I respect the difference in my role versus a GP's role, right? So I don't think it's my role to say whether this is not a bad deal. What I do think is my role is for anyone that we have that is invested in this deal to ask their rationale. And to see if that's aligned with what we invested for, if we feel like that's in there, in the profile of the expectations, if there was and that probably would go for a lot of different deals that we've seen much ink spilled about in this market. So that's usually my approach.
Okay, I will go out on a limb and say, as someone who is fortunate enough to be an LP in at least one of the funds that invested in Figma and that will do really nicely as a result of this, Figma looks like a one-off. And Joanna, you referenced earlier, I think, about fear, and there is certainly an extent to which fear is a great driver in an M&A process. So whether the technology is amazing or not, story to come, and we'll see if the deal closes. The good news is if there are 2, 3, or 4 aberrations, it starts to become a trend, and that's certainly a possibility. I want to talk a little bit about crypto and other currencies, because a lot of people have talked about the huge swings in the crypto to dollar pair. There's a huge swing in the euro dollar pair. There's a huge swing in the GB, in the British pounds to dollar pair. That actually has a real impact on investing into and drawing dollars per invested dollar from funds that are denominated in the other currency in that pair, right? If you put $1 million into a euro denominated fund, that $1 million is worth a very different number than it was a year ago, and it may be worth a very different number. And there had been some real stability for a while in the euro dollar pair and in the British pound dollar currency pair. Is that going to have an impact on allocations, do you think, into European denominated or euro denominated funds or British pound denominated funds, or from LPs in places where they're based on euros or pounds?
I think it's going to be very LP specific. For most institutional LPs, we run a globally diversified portfolio, and we pay attention to the underlying currency exposures. And you certainly pay more attention when they're going against you, as they are right now. we have looked at our European exposure specifically and have felt comfortable with the level, but would we look to add, a lot more exposure? I think we'd be cautious. I think the other piece of it is if you look at an LP's portfolio and you say, what levers can you move when it comes to exposures, you are more easily able to move the public market levers than the private market levers. So if I have a world-class European GP to whom I've been able to gain access and they're coming back with their next fundraise, I am unlikely to walk away from that position at the table. And if I've built out over our skis, we can lighten up on the public market. But what it may mean is for LPs who are concerned about the exposure, that if you have a European manager who is looking to build a relationship with you, you might just say, you know what, we have adequate exposure in that geography and are not inclined to add. I think the other piece of it is understanding the companies that are being built. So even if the fund is denominated in euros or sterling, are the companies that are being built local players, or are they going to be global players? And if they're going to be global players, the denomination of the fund may not be as critical.
What about the dollar cost averaging, right? If you commit, so unlike an angel or venture investment where you invest today and all the money goes in today and then it comes back when you sell, you're paying in capital over time. And therefore your dollar cost averaging, your conversion from dollars, if you're sitting on a dollar denominated pool of capital or otherwise. And so your $1 million commitment, which you assumed would buy 750,000 pounds, is now going to buy, a much different number, but it's not really keyed off of the amount at the time that you allocated to it. Does that not change your risk assessment of it?
I think it's and I think to Joanna's point, I think it is going to vary from LP to LP. I think what we build portfolios structurally to weather is right, like to think through those long-term issues, right? So if we know that we are managing a portfolio that has liabilities that are denominated in different currencies, right? Like usually we can use an overlay to manage through those issues, or we already have different parts of the portfolio, right, like that are denominated in those. And this is why people are right, like are planning their 2023 budgets, right, like already, is because you usually can use different cash management tools to manage those. If we happen to be managing a portfolio where maybe your currency, your income or your funding is denominated in one currency, and maybe your liabilities, including your commitments, are in another.
And speaking of 2023 budgets, you mentioned that people are doing that now. Were they not doing that? And this is something that Molly Fowler from DRF mentioned in the chat. Weren't they doing that in late spring? I mean, aren't people like already saying ladders up for next year or for the first 3 quarters of next year? Get in the queue now or tell us now.
It's something that I'm actively, well, there's 2 pieces of it, right? So it's us understanding what our forward calendar looks like for fundraising with our GP relationships. But then it's also working, with our clients also to say what do their budgets look like, and aligning those. And so I think there's 2 pieces that probably happen at different times. But given that we know, I feel like fundraising is quiet right now, but I think it's just people kicking down. I haven't heard of anyone that says we're raising a smaller fund or not at all, right? So I think we're just kicking the can down the road.
So there'll be a glut of fundraising in Q1 of
I think so.
23.
I don't know,
Which-
Joanna, I think so.
I think so. I think there are a lot of folks who are heads down triaging their portfolio. Their LPs have told them, you know, we're unlikely to be able to move quickly. Come back.
Okay. And is that strategy where everyone is trying to wait out a lousy market that might only get lousier? Is that a misguided strategy, or do they kind of have no choice?
I think you have to listen to the market, you know, and I think there are a group of folks who've been able to raise, right? If you've got very strong returns, if you've shown an ability to navigate through these markets, like if you have the GPI over the last couple of years, if you had your portfolio companies in great shape, it's interesting because everyone will say, you know, a year ago, this is great bullish time. But I've been surprised coming out of it. You know, we have a handful of managers who are like, yep, 90% of my portfolio has a year or 18 months worth of runway. But there were a couple of managers who were very experienced. And I've been surprised to look at their portfolio statistics and see, you know, we had one manager, half of my portfolio has to raise in the next 8 months. So so there are a handful of managers who showed an ability to navigate the last couple of years, and it's coming out in the numbers, and they're able to raise. But I think for most managers, you know, they're being told by their LPs to take your time and push it out. Now, to your point, Ed, I think it's going to get more challenging rather than less challenging, but I don't know that they have a choice.
And to be clear, these are GPs across the spectrum, right? So this is not just emerging manager GPs that are probably going to take longer to fundraise. We are, you know, having conversations with very well established, you know, fund managers that are on, you know, funds, you know, 9, 10, 11, right? Like that are expecting their fundraise to take longer than they expected. And I think you probably see fund managers that close below, you know, what their targets were. I think it has to happen.
And when you look at the funds that are returning DPI or dollars per invested dollar, is there so I've seen people knock GPs for selling early. Are we now going to say, well, they sold early, but they did 2x the fund, or they sold early, but they did trip into carry, meaning, you know, they got at least 1 times the fund so that the people running the fund can start to get what's called carry, or the incentive, which is typically, you know, 20% or so of every dollar returned above the cost. Are we going to now move to a cycle where it's more of a like, show me the money, and if you sold early, we can complain, but first sell early, and then we're happy to complain a little bit?
I think that's very much like, we have a couple of managers who sold into rounds a year ago, where they said, you know, the price was well in excess of what was deserved. And certainly the company may grow into it over the next 3 years, but we have a chance to take some significant money off the table right now. And then that will have been rewarded. I think the flip side of that coin, Ed, is we had a lot of managers who held stocks. Like, we're looking back and saying, what did this manager do well? And what did they really get wrong? And the thread that we're seeing is managers did not distribute. They did not sell things that had gone public. And, that's where we were having a lot of, like I talked about, a 4.5 going to 3.5. If you held a bunch of public market stocks, your 4.5 is now a 3.5.
Yeah. So think about, I think it's, and right, like maybe the secret just amongst us is, right, like no matter what, right, like nobody's gonna be perfect. LPs are always gonna ask questions and have criticisms or views, right? Like what I look for in those questions is your line of thought and rationale, right? So if you held that stock and your skill set wasn't trading in public equity markets, right? Like explain to what was the investment thesis at that point after you held it through multiple, right? Like just what was the rationale? And I think whether people like it or not, I think if you have a solid explanation, then I think people are willing to accept that. But if you didn't, right, like then I think that's where you run into trouble.
And there's a question from one of our funds, Slauson & Co. And the folks at Slauson & Co., in which we are proud investors. Do you anticipate that the valuation reset is going to be over the next quarter or two or the next year or two? And how does that impact how endowments think about allocation to venture capital as an asset class over the next year?
I think it's a year. I don't think it's a quarter. I think that, and maybe Slauson is in a better position to answer this than I am, but the correction only comes when founders, GPs are willing to start taking markdowns, right? And I think that they are going to run that. My view is they are going to run out that clock as long as possible, right? So what we're hearing from managers is maybe here's where a portfolio company is marked at, and maybe there are not, operational issues, but if they have that runway of a year and a half before they need to go and fundraise, that their valuation, that their policy is that they will reprice it when there's a next formally priced round. What I will also say is I think that investors are getting increasingly creative, about how to fundraise without having a price round, right? And so I think, it just gets long. So I don't think it's quarters. I think it's going to take a long time. And the unfortunate part is that I think in some ways, this is what creates the standstill, right? Because then we don't know where our portfolios are properly marked at, which I think is part of the hesitation and why GPs are taking longer times to write checks, because I don't know where my existing lineup stands.
And as a deal lawyer, we at Lowenstein are spending lots of time, especially but not exclusively, on growth companies that did massive rounds and are now shoring things up. They've all done their cost cutting, and we're spending a lot more time actually figuring out how do we get a round done that looks a lot like an extension round rather than a down round, or that avoids pricing. And we've been in a market that has innovated both documents like safes and also the seed strategy in the last dozen years and the pre-seed strategy in the last dozen years. Those things have been really super popular, and a market has gone really, really up. When you use a safe, there is often a ceiling or a valuation cap. There is no floor. And there will be some real regret over the use of something that has a valuation cap but no floor, when you could have priced flat or maybe taken the write down on a on a down round and right sized. And you talked earlier, Joanna, about alignment of interest. There is alignment of interest, right? The CEO maybe doesn't want a huge markdown, and the fund manager does not want to have to mark to market I'm not saying that the fund manager would do this to avoid market for market, just, it could happen. And so and I know I see Torin has asked about elaborating on new techniques being used to avoid pricing rounds. I don't know that they're new techniques, Torin. I think it's more like we will do a flat round, so it's the same share price, but we'd like a 2x liquidation preference. Or we'll do a flat round, but give us warrants. Or instead of doing a round, we will raise convertible notes and they'll have these additional features. And those are things that do avoid a repricing. At the same time, employees who feel that their equity incentive is no longer compelling are looking for repricing of their stock options. And so we're spending a lot of time repricing stock options. That has some complexity built into it, because if you are repricing non-statutory options or NSOs, that's easier. If you are repricing incentive stock options that you've already been holding, because there is a requirement to hold incentive stock options or ISOs or qualified options for 2 years after the grant date, you're giving up a tax benefit, and that requires disclosure, and it requires a 29-day period to keep the offer open. And so we are seeing people have to reevaluate their stock price in a number of ways, some of which may be inconsistent. We want to keep our preferred stock flat, but we need to lower the price of our common. So we're seeing more of those kinds of things, and hopefully that answers Torin's question a bit. As a result of that, venture is historically a market characterized by opacity, and it will remain opaque because those markdowns are going to be hard to find, and it will take a while. So it won't be, I don't know if like 2020, 2021 as vintages are going to be vintages where the true benchmarking that Cambridge can do on multiple of invested capital or total value per invested dollar comes 7 years from now, or 8 years after vintage or something. But it's going to be really hard for the next year or two. And in light of all of that, I want to see if I can get a clarification. Jasmine, when you said you don't think it's a quarter, you think it's a year, does that mean that you think valuations will continue to slide for a year so that we're not at or near a bottom? Or does that mean that you think that we may or may not be at or near the bottom, but valuations are going to remain relatively compressed, multiples are going to remain relatively compressed, and that's going to look more like a year from today than it will a quarter from today?
Yeah, I think more so the latter, right? Like I think last quarter the markdowns that we're starting to see rolling from now, right? Like maybe marks are off 4%, right? Like we know that that's probably doesn't intuitively feel correct. And so yes, I think it's probably not a slide, right? Like it's more of when I think underlying portfolio companies start to run out to cash, get forced. And so maybe it ends up playing out such that there will be companies that will be able to fundraise, and then there are some that will cease to exist. And so maybe that's more of how this plays out versus these marginally marginal down rounds. I don't know.
I heard an LP or a GP say the other day that, if you believe that many of these underlying portfolio companies raised enough cash to last 9 months to a year and a half, it's going to be tough to get the valuation reset until they're back in the market. So I haven't looked at the data, but I think that's going to be an early indicator of when we're actually going to see some of these valuations reset.
So there are two questions in the chat that kind of relate to each other. One is from Patrick Anderson, who asks about the impact of dry powder. And then Julie Robleski asks how the significant amount of dry powder in mega funds will influence the market going forward, and how will this play out for micro funds now and in the next few quarters. And that's a great question. I will just preface by dry powder means that the fund still has a lot of cash to deploy. And if you go back to Joanna's comments about fear and greed, what we saw in 2000, for those of us who were doing these deals in the last century, and I know that that makes me sound old, but it's only because I am, we saw people really be unable to pull the trigger because they kept waiting for the bottom, and they waited to absorb the pricing info, and things did get worse for a while. And we also saw people leave the market. And in this case, we do have these funds that raised an unprecedented amount. And as those funds have moved a bit earlier, is that pent up investable capital going to put some pressure on early and seed and pre-seed pricing?
I think in some ways, I would say in general, my expectation is that yes, I think the pressure continues, right? Because I think a lot of those funds, trickle down market, right? Like they've expanded staff, maybe they now, have more dedicated resources to look at smaller deals. I think also there's the emergence of hedge funds, right? Like that have raised these side pockets to invest in privates, and that's not stopping. And so I think that adds to the dry powder. What, if I'm being hopeful, what I hope happens is that investors recognize the opportunities that's before them, and maybe we have more rational pacing, particularly if you anticipate that it's harder to go and fundraise from LPs. So rather than trying to massively deploy a lot of this, the dry powder, I hope that what we're investing is a market where people see this as the opportunity of 2008, 2009, right? Like 2010, which were amazing vintages. And so hopefully, so my hope is that that you don't have this rapid deployment, and that GPs don't come down, but I don't know.
I'm going to echo Jasmine's hope. I also hope that there's, kind of an understanding of what people's swim lanes are, and that there are certain skills that are required, and they do vary by stage. And in the in the recent environment, everyone's been successful doing everything. So I'm hoping that those larger funds with lots and lots of dry capital don't come down market. I think the other thing that's going to be interesting is, do entrepreneurs become a bit more discerning regarding where they're taking capital? And is it, it was speed and price, and maybe it's going to be less speed and price and more, I want a partner who's going to work shoulder to shoulder with me.
So I hate to be cynical, but people say like, oh, this person is cynical because they're a lawyer. And I actually think it's the reverse. Like, I became a lawyer because I was born cynical.
And you live in New York? Well, sir.
Yeah, from Brooklyn. So the cynicism was, kind of earned. Also, like, people outside of New York talk about the quality of their bagels, and just stop. So the cynicism is, yes, people decided on the basis of speed and price, but I have always been astounded. And I said earlier that the phrase top tier was something that I had an allergic reaction to, because I've always been astounded by how frequently founders are impressed by and will select a fund based on the number of times that fund tells the world that it is top tier. And there kind of is no such thing, right? We allocate capital and we allocate deals based in significant part on branding rather than performance. And because performance is so opaque and takes so long, and we don't have the luxury of time, we're going to continue doing that. I say this as someone who spends a lot of time advising founders, right? That's what we do at Lowenstein. We do venture deals, often representing companies and often representing funds. But are you seeing that? Like, how much does brand equity play into your decision?
I mean, we I guess have the benefit of actually seeing the returns and trying to understand the portfolio construction, and to a lesser extent trying to understand the metrics of underlying companies. So I'd like to think we're good at our job. You know, there are some well-known, well-respected top tier firms that I wouldn't invest in. Like, I've seen the numbers. Now, am I subject to the same FOMO or being enamored with certain brands? I'd like to say that I'm totally immune to that, but I wouldn't make that claim. I would also say, Ed, to your point, you know, I have to understand what the entrepreneurs are going to find attractive. And, you know, there are certain brands that can attract entrepreneurs, and hopefully that translates into strong fund returns. But because we can see the data, I think we're a little bit better at discerning where the smoke is and what's fire.
I think first there's different brands, right? So if and I think there is a manager that we're all invested in together that I think has an amazing brand among founders, but they built that based off the partnership and the work that they do with founders, not because of their Twitter threads and glossy pitch book and so I am much more interested in the brand you have, to Joanna's point, among founders and for doing the work and for playing the long game versus I think a social media brand, which quite honestly, as an LP can become concerning because I don't want to have to worry about what's on Twitter over the weekend.
Okay, well, I appreciate your time and the generosity with which you shared your insights. I'm going to want to circle back on Jasmine's comments about, I think it was 2/3 of the top 10 performing funds in each of the last 3 years have been emerging, meaning it is a fund 1 or a fund 2 or a fund 3. Is that right, Jasmine?
Correct. Yeah, over the last 10 years, 2/3 are from emerging managers, and 45% of those are funds 1 and 2. So yes, I think that's kind of informs our view on quote unquote brand.
Okay, and that is a great place to end. And I want to thank our amazing VentureCrush team. And there's some things in the chat on VentureCrush Americas, as well as the Women in Venture term sheet session with Alyssa and Meredith and VentureCrush Africa. And thank you all for tuning in from the Lowenstein Sandler outpost in my home office. I'm really happy to have this conversation. Appreciate all of you being here. I see Ulu Ventures here. I see Black Tech Nation Ventures, the Slauson folks, Magnify, and it's great to be in community with all of you on this. So thank you again for taking time for everything. Hope to talk soon.